Jeffries downgrading energy to underweight, saying the forecast for oil and natural gas are hurting the sector. Meanwhile, Evercore says hedge funds are long energy. That brings us to one of our 2026 picks. Joe, it's yours in the energy space, EQT. Why are you so bullish on this name going into the new year?
Well, I've been bullish on this name since 2024, and this is not descriptive of some belief that I think energy is going to be an outperforming sector in 2026. I don't think anyone really ultimately knows that. People that are buying energy right now are seeing the underperformance and the cheap valuation, and that's what they're attracted to. In terms of the fundamental for energy, right now, as Jim and Steve correctly point out, if you focus on fundamentals and you look at the energy sector, you realize that consumption relative to supply, there's an extreme dislocation there to the tune of arguably 2 million barrels per day. So what does EQT actually give you in your portfolio? It gives you exposure to a name that has very strong, first and foremost, momentum. Secondarily, strong relative outperformance to the industry itself. Natural gas pricing has been on decline, but there is clearly a resiliency for this corporation in the face of declining natural gas prices. And where does the resiliency come? It comes from their ability to generate very strong free cash flow. They've made a series of midstream acquisitions that have worked to their favor. And then being in the Appalachian, they have what I would call prime geographic exposure to really where we see a lot of robust data center demand, in particular for Virginia. And ultimately, natural gas is going to be a power generation solution for that data center demand. So I love the way this company is positioned. As I've said, I've owned it since the mid-30s in 2024, and it really hasn't even had the benefit of a rise in natural gas prices. And when you look at how this company is hedged out going into 2026, a rise in natural gas prices would really benefit them because they're largely unhedged in that regard.
Yeah. I like your call, Joe. I just want to point out, you said natural gas pricing is a little lackluster. It depends on your time frame, of course. You go back two years ago, natural gas was trading under $2. Now it's a little bit under $4, and that's I think that's basically what the energy sector has been riding on all year. It's certainly not crude oil, which is down whatever it is, 20% year to date. Natural gas is strong, and it's going to be strong for exactly the reasons you pointed out. Steve, I know you're in Caterpillar, or at least I think you're in Caterpillar. There's a great Wall Street Journal article, I think yesterday, about how CAT is basically building its natural gas-fired generators as fast as it possibly can to allow data centers that don't have connections to the electrical grid to power themselves.
There's so much going on with alternative energy, but my view on energy, traditional energy, is I haven't changed. It's a very, very difficult sector to make money in. It's very situational. That you can, if you put up a 10-year chart of a Chevron or any of those, you're going to see that's basically flat. Now, it may not include dividends or not. I don't know what they use for charting, but I don't even know why you waste the time. And I'm not saying on an EQT, there are idiosyncratic stories that do make sense and do work out. But overall, I mean, you can make a lot more money elsewhere and save a lot of aggravation. Even the chart of EQT, you've got to be willing to tolerate that chart. And if you look at look at that volatility. So I'd just rather, lose money elsewhere, and I'd rather, not be as aggravated.
Pull the chart back over the last 2 years of EQT.
Yeah, and it's up versus where it was.
And you'll see the resiliency I'm speaking towards. Look, Steve's right. Energy investing is difficult. Also understand
I also think it's rigged.
Well,
I think it's rigged not in the crooked sense, but that there are some very large players, some players that only do that and they control the markets. I'm not insinuating that there's crooked or anything illegal. I'm just saying it's rigged by those big players and where they want it to go and the leverage they use in the futures contracts. And then you have the Saudis and all the others. So as a tourist there, it's very tough.
Well, the commodity space is very concentrated in terms of the pool of participation. Right. So, in fact, that ultimately what you're describing could occur. But there are some in the energy sector, some winning names so far year to date. ExxonMobil, I think, is close to a 52-week high. So you don't want to completely disregard it. I know when you speak to a lot of financial advisors, what they're saying is, okay, we're going to extract the energy from our portfolio because it's only 3% roughly of the S&P. We understand President Trump and his administration want lower energy pricing. And guess what? We are going to place in the portfolio utilities as the alternative to energy because we like where utilities are with the AI data center demand.
And just keep this in mind, one more point. If you overlay that XLE chart against the S&P or NASDAQ, you'll see that go way on the bottom. The underperformance is stark.
We keep touching on this AI data center trade. I want to bring up the news today. Nvidia getting an order for about $16 billion from ByteDance. I think that leads us to one of our next picks in the chip space. Steve Weiss, going to come over to you. TSMC, this $16 billion order from ByteDance to Nvidia. A pretty exciting thing. I think it has to change some of your sentiment when it comes to Nvidia from earlier this year. Nvidia's had some certain volatility as well, and I think people have changed their thought. At first, there would seem to be in the middle of the year some thought that the chips might be commoditized, and the TPUs came out. There might be a rise in competitors. Then you see this. Yeah. So I want to go to your pick, though, TSMC. How does this news shape your view of TSMC in that pick?
It's ratification. First of all, I do own Nvidia. It's a much smaller position in Taiwan Semi, which is my largest position. Look, Taiwan Semi, they're agnostic. It could be the new Alphabet chip. It could be a Meta chip. It could be an Amazon chip. It could be an Nvidia chip. It's being made at Taiwan Semi, chances are. And Taiwan Semi, it's not just a manufacturer, it's also a design company. The biggest risk, of course, is a Chinese invasion, but, you know, Alibaba's in China, and they're still operating, and I own that. So I think Taiwan Semi, it's growing cash flow, EBITDA at 20%, revenues 20%, operating income at 20%. Its EBITDA margins, its EBITDA multiple is about 11, 12 times. Think that versus Nvidia, I'll just guess. I'm going to put Nvidia at 30 times. And it's much more predictable earnings, and it doesn't have to worry about the competition. So that's why I like the PE's 20 times. So it's a one-peg ratio in this market with the value of those assets. It's ridiculous. So that's why it's my largest position.
We got another pick in the chip space, Jimmy, coming over to you. You previewed this yesterday. You were talking about this company yesterday, shifting away from mobile phones.
Yeah, well, it's Qualcomm, and I do think that it is still too much regarded as just a cell phone chip manufacturer. They've done a great job diversifying, first and foremost, into automotive, but Internet of Things, and both of those aspects of their businesses are growing at 20% year-over-year compound annual growth rate. By the way, that's not just a one-year, hey, flash in the pan. That's what they're actually projecting through the end of this decade. Add on top of that the data center chips that they are now going to be putting into the Humane project in Saudi Arabia, and they look like they're going to be a legitimate player within the data center space. So you're getting this stock well diversified at 14 times earnings, 2.2% dividend yield, basically no net debt on the balance sheet, which means they can do any of a number of things, some strategic acquisitions if they want, maybe do an accelerated share repurchase. I just see an asymmetric trade here, likely that it goes higher as opposed to going lower from here.